Thank you so much once again for everybody that's joined. I feel like we're doing a very timely conversation about something that's being discussed quite a bit right now. But before we get started on that, one of the other things I wanted to point out that we're very excited about, this is the first time where we have members from both Evans May Wealth and Evans May Advisory here together. For those of you that may not be familiar with either firm, just some background. Under the Evans May umbrella, we have Evans May Wealth, which provides wealth management related services. And we also have Evans May Advisory, which provides tax and accounting related services. Now, just for some backgrounds about myself and my colleague here, Owen, my name is Darin Riddle. I'm a financial advisor here at Evans May Wealth. I've been in the business for about 17 years, hold the designation of a certified financial planner. And Owen Pryor is CPA and managing advisor for Evans May Advisory. He has been in the finance and accounting industries for over 20 years now, worked with individuals, families, and businesses to provide strategic tax planning services. Now, if Owen and I look familiar to you, Owen and I actually did a video series a couple months ago about year-end planning, which is still available online. So if you haven't had a chance to take a look at that, it's still there. But for today's topic, we're going to talk about the Big Beautiful Bill, or the OBBBA. So there's a lot of things in the news about it right now, a lot of headlines. What we're going to try to do today is try to take away from a lot of the confusion that's out there, try to make things very practical. We're going to touch on as many topics as we can. So we're going to cover things like Social Security taxation, Roth Catch-Up rules, expanded use of 529s, and even impacts on charitable giving. One of the things I want to highlight too is just from a housekeeping note is at the very bottom of your screen, you should see where it says Q&A. If you click on that, you can type in questions. We're going to leave as much time as we can at the end to try to address as many questions as possible. If we don't have a chance to answer your question, we'll try to follow up with you because I know there's a way where you can indicate a question anonymously or leave your name. But like I said, we're going to try to leave plenty of time open for that. So getting to the topic at hand. So we're going to keep things pretty broad to get things started. So Owen, if you could at least just give us a baseline about what is the Big Beautiful Bill, just to kind of get things started.
So the Big Beautiful Bill was a new tax law that was paramount to talking points through the election. And it was super important to the new administration. They wanted to capture all of the promises. So as we go through some of this, is we'll talk about what were political talking points and then what the reality is and how it impacts families, business owners, businesses in general, and then how the timing and phase outs are really going to be important to understand in your tax planning and how you're going to manage, your family's activities around taxes.
Okay, so let's start with one that I get a lot of questions about because I think it's been in the news probably the most, as one of the headlines is. Sure. When you hear the word no tax on Social Security, okay, what is that? So talk about that. How does that affect people?
Yeah, and don't mind me if I look down occasionally. I've got some bullet point notes just because there's so many different phase out exemptions here. So, really focusing on the no tax on tips. It's similar to the no tax on overtime and no tax on tips. So focusing in on what is a political talking point. So with no tax on Social Security, the rule that up to 85%, that's still in place. Certain earners are going to be phased out completely of this no tax on overtime, just like certain earners would be phased out or limited to a deduction for no tax on overtime tips. So specifically with Social Security, is up to a $6,000 for a single filer and $12,000 for a married filer. They have to be 65 plus, and their income, it's a range of up to 75,000 for individual and then 150 for joint filer. That's where the phase out begins. And then so when you get to 175 or 350,000 for a married filing joint, that $6,000 goes away. So that's where some of the talking points really kind of don't overlap reality. So that's really what we want to try to bring to our audience is understand that, you're still going to have to tax plan around up to 85% of your Social Security. It's still on the table.
Well, I think that's a great point. So a lot of this is, it's talking points, but it doesn't affect everybody the same.
Correct.
And it sounds like from what we were saying there, and I know this is going to be for other things, that once you get past some of the headline stuff, once you get into the actual details, that's where it affects people differently.
Correct, correct. And understanding there's planning opportunities around, this new bill. And that's where, having two partners, a CPA and a financial advisor walking alongside a client is so important. You and I can talk about, hey, is this going to be a high income year? Or is there a way to mitigate and move some income around and bunch income or stack income in a later year, take advantage of some of these deductions? Same with some of our topics later about itemized versus the extended higher standard deduction. So there's some strategies there to kind of figure out what's best for that client's individual situation.
And then also just on specifically, with no tax on Social Security, no tax on tips, no tax on overtime, is that permanent or is that set to expire at a certain time frame as well?
Right. So that's a great point. Great question. It is set to expire in 28. So some of these strategies, again, we have to look at the timeline of when they actually come into play. So for 25, it's in play. And 26, 27, then 28. Then after that, it's gone. So if you want our clients to really benefit from that deduction, we're going to have to be forward thinking right now in the short and near future.
Okay. Yeah, that's great to keep in mind. It's all about planning and then kind of think about when that's set to expire. Anything else on Social Security? I mean, you mentioned still about so much of it being taxed. Just to confirm, there was no changes in regards to up to 85% being taxed on that.
Right.
Is that correct?
And this is an interesting conversation because it really looks at what has changed and what hasn't changed. So that tiered approach, where if your income is below a certain threshold, it's 0% tax. The next bucket is 50% is tax. The next bucket, and then to like infinity, essentially is 85%. So that's unchanged. So having that conversation and understanding that your Social Security is still going to be taxable depending on certain situations. A lot of people that are going to feel the most results are the lower income earners. The higher income earners are probably going to be phased out at least to a certain extent. And 6,000 is a deduction. It doesn't wipe all that 85% that's subject to tax.
Yeah, big difference between deduction and credit for that standpoint.
Yeah. It's a deduction to reduce what's taxed.
Right. Yeah. Okay. Well, that's great. Yeah. Thanks for sharing that. That's been in the news quite a bit. I'm going to shift to another topic that seems to be in the news quite a bit, is Trump accounts. So let's talk about that. Let's start. I'm going to keep it very broad because you and I have been talking about this even prior to this, is that there are still a lot of things that are being worked out in regards to how this is going to be implemented specifically. But I'll turn it over to you. Explain what Trump accounts are. What do we know about them so far?
Yeah. So this is one of the things that came out of the bill that was pretty unique and creative, in my opinion. And what happens is a lot of times children aren't able to participate in tax advantage accounts because even getting into a traditional IRA, there's an earned income threshold that you have to meet. Well, if you're a toddler, you can't participate in the tax advantage growth. And by tax advantage, that means the funds that are put in there, they can grow tax free. So some of these funds are going to be very carefully curated. It's not going to be the wild, wild west. We're not going to be doing alt investments and derivatives. I'm not trying to get in your lane, but that's not what these accounts are designed for. They're supposed to be, based on US based, stock market, the S&P 500 type EFT.
Like index funds.
Yes, index. Thank you, sir. So what's going to happen is children that are born in 25 to 28, and I'll use the word may because with accounting speak, you always have to say it depends because things can get shaken out of this bill that, there's a carve out for this. So they may be able to qualify for a $1,000 deduction from the Treasury Department. And then on top of that, every single year until they're 18, they can have $5,000 put in. Now that $5,000 can come $2,500 from an employer or $2,500 from the family. And then I know we spoke offline, and this is a new wrinkle, is they're starting to look at how the law was written and use how the $1,000 got in there and to see if other state and local governments or charitable organizations could then fund on top of the 5,000. So stay tuned on how that's going to look. And then the other part is looking at it from, there's no tax advantage reason to put money in. You're not going to get a tax deduction. It goes in post-tax. But like I said, it does grow tax-free. So in the way they're treated after 18, and they can't take those funds out before they're 18, but it essentially turns into a traditional IRA. So similar rules apply. You can't touch it until you're 59 and a half, or it's going to be subject to a 10% penalty. And again, some of these rules are subject to change, so don't hold my feet to the fire just yet. And there's certain ways to pull those funds out that can escape that 10% penalty. And another key is the principal that goes in, that can be pulled out, and that's not subject to tax. It's just the growth. While it's growing and you don't pull it out, there's no tax. So if they maintain that account and they keep it up until they're in retirement age, that is a very long runway to build tax-free growth in a portfolio.
And the other thing you and I were talking about too is that, potentially this year is the first year it starts, but it actually doesn't start potentially until July is when that would.
That's right. Contributions may not be made until July.
And then also about just maybe you can share about the tax document that needs to be completed when you're doing your 2025 tax return. I believe there's a document that needs to be filled, or at least the CPA needs to be aware of it to try to get.
Yeah, so that's part of the IRS trying to catch up to the tax bill. So there's provisions out. We're still working on making sure that those are ready to be filed and timely documented for children that were born in 2025. So
okay,
yeah,
still a lot of things I think that need to be worked out on that, but it's at least something that's being discussed as we're getting a lot of questions on. So let's pivot here. Let's go to tax brackets, estate exemption amounts. Talk about that. What was done within the big beautiful bill on those things?
So this bill, and one of the reasons it was streamlined and made such a priority, not just to hit the promises on the campaign trail, but it was meant to address what, a lot of people are referring to as a cliff. So in 2026, there were a lot of provisions that were going to go back to pre-Tax Cuts and Jobs Act of 2017. So the highest income tax back in place, and that's 39.6, or it was. Well, now that's being set permanent. And again, remember, permanent's only until a new administration or new Congress changes the tax bill. But for now, there's no cliff, which that's how they're using the word permanent to essentially establish that. And it was very similar to the estate exemptions. There were a lot of people, and I'm sure that you've had a lot of calls over the past few years about understanding what do we have to do before the end of 2025 to make sure that we're not losing the opportunity to cash in on the exemption. So there's ways to use different trusts to go ahead and cash that in, gift it to a trust, use the exclusion before it dials back, and then you don't have as much of an exclusion. So that's essentially gone to where it's a lot more predictable. It's set at 15 million for single, and then 15 times 2, 30 for married filing couples. And then, and one thing I wanted to point out, and this is an important tax strategy or rule, but if one spouse dies before, and they're at a high net worth, they should file an estate return, and any unused can be transferred to the decedent, the surviving spouse. So just wanted to throw that out there. And it was, it is important to understand, the tax brackets. They are set in stone for 25 and obviously 26, and they'll be indexed for inflation as per usual. But for now, it is going to be a 37% highest income tax bracket moving forward.
Yeah, that helps. Definitely from a planning perspective. To your point, obviously things can change based on new bills and new laws and things like that. But it at least gives you and I the ability to work with our clients to at least be able to at least think through the rules that we know now, instead of there being a mad dash of trying to get something done based upon a bill set to sunset. So at least we have some firm footing there, at least for the time being. Anything else from a tax bracket or exemption perspective to share?
So, I mean, I would think, looking at your strategy moving forward is, there's a 37% cap right now. You're a super high net worth income earner. What do we think is going to happen in the next 4 years? Is there anything that you want to pull forward, match deductions based on? I would think that's at least worth a conversation to make sure you're being thoughtful in that.
And I know you and I have talked about this too, about just how important it is to have a long-term plan in place and really do some of those projections and factor in what we think based upon different strategies, what the tax impact is, not just for the next 5 years, but also for the next 10, 15, 20 years, even multi-generational for that matter.
Yeah. And if you've got the right team in place, that's something that you can be very creative with. We talk often about, looking at those, identifying different appreciated stocks, how we can be creative and help navigate and move around those income tax brackets and get the best bang for your buck for your strategies.
Yeah, and I actually think that's a great lead into charitable giving. So let's pivot to that, because I think you mentioned something there that's really important in regards to securities and things like that. So when we talk about charitable giving based upon new rules and the big beautiful bill, share with us what changes are that.
Well, and I'll pivot back just for a second because it's very important for the changes and then what change. So there's still the buckets available for cash donations, 60% of AGI, appreciated stock at 30%. And then there's also still the donor advised fund, which you and I love to talk about. Triple, tax saving strategy with a contributing appreciated stock. You don't have to pick up the gain on the income. And then it goes in, you get the deduction. It's just a wonderful tool. And then you can spread out those deductions. So keeping that in mind, the new rule starting in 26 is there's a new AGI limit. So that's adjusted gross income. So that's before you get to your itemized, it includes a lot of your income items to get to your adjusted gross income before deductions, before your standard deduction or your itemized deduction. That's what that indicates. So, and it's a 0.5%. So I think I did the math. So if you're at a $200,000 AGI, the 0.5% floor is you're going to lose $1,000 of your charitable deduction. So not the greatest tax law change, in my opinion, but it is the rules that we're having to deal with and navigate. So the best way to look at this is from a planning opportunity is to understand the 0.5 is there and what can we do creatively to focus on stacking deduction in higher income years or lower income years, depending on how that little threshold looks to capture the understanding that we've got multiple moving things to think about. We have the threshold, we also have higher income tax brackets.
Yep.
So again, this is where some of these changes, they kind of play on each other. So we have to be very thoughtful and figure out, the strategies that best fit the situation. And then also keep in mind, you won't want to let the tax tail wag the dog.
Yeah, that's where it's more thinking about what is the long-term strategy from a charitable giving standpoint, and then figuring out what makes the most sense. Obviously, I always tell people when it comes to charitable giving, you want to give based upon your willingness to give. And then based upon that, let's figure out the most tax advantage way to do it. And I know in our end of year planning video series, we spent a lot of time talking about charitable giving, different strategies there, because I think it's really important to think through the right assets to actually give to charities. So what you mentioned there would be rules that affects those that itemize. So a lot of the same rules are still in place other than just what you mentioned there about the floor. Now, one of the other things that I get quite a bit is for those that do the standard deduction. Now the standard deduction has gone up so much. Share what that means, what the new rules in place are, those that use the standard deduction now for charitable giving.
Yeah. So the Tax Cuts and Jobs Act really threw a wrench in a lot of the people taking the itemized deduction approach. There was a SALT limit of 10,000, and the higher standard deduction is now made permanent. We've done the carve out with what the permanent. That's So one of the things to keep in mind is based on your AGI, the SALT limit that was at 10,000 has been bumped up to 40. So let me refer to my fact sheet really quick. So if you're at below $500,000 of taxable income, you're going to be able to get up to $40,000 of SALT. So that's a game changer for a lot of our clients that are below that income threshold. So that really puts itemized deductions back on the table for a fair number of, taxpayers. So as we walked through, and I did this today earlier, is slowed it down and we looked at what they were actually paying in. And then they're so used to not looking at all the different SALT elements, which is state and local taxes. So we had to make sure we got their car tax. We had to make sure we had all of their property tax. And then we had to look at what they paid in for income taxes. And that was a much bigger number than the 10,000. And that immediately shifted their gear to go back and, oh, well, let me go back and pull all of my charitable giving. Because they were just not used to. They kind of were sleepwalking through, not remembering how to make sure they itemize versus the standard. The standard was much lower. So, and there were no limits on SALT. So the other part of that is if you're a small business owner, this is a way to get creative with how you leverage your pass-through income tax with flow-through income at the state level. Because you're taking what used to be a SALT deduction on your 1040 individual itemized deduction, moving that to be a federal deduction on your business return. So looking at different strategies around there based on the current year, the situation, how do we leverage wages, QBI, that's another business provision that was extended. That was huge. That's a deduction for 20% of your flow through income from a business that qualifies. And those are obviously subject to limitations and rules. But coming back full circle to the SALT, I think this is a good opportunity to slow down and really see how we used to use our itemized deductions and see if we can't pull in some of those strategies that we haven't had to worry about in a while. So I do think this filing year for 2025 is going to be important to slow down because the rules have changed. They changed in the middle of the year and some of them were retroactive.
Well, and one of the questions we'll get to towards the end that I've been starting to get now is, okay, now that we're in 2026, is there anything I can do for 2025? So we're going to come back to that at the end because I think that's really timely for a lot of people right now. So I think we covered a good amount there on the SALT deduction, the changes there and how what that's that in the big beautiful bill. Let's pivot here to talk about Roth Catch-Up. There's a big change there. It affects a lot of people, specifically if you're still working, have access to a 401k primarily, but I'll turn that part over to you. So explain what that was in the big beautiful bill, how that affects people.
Yeah, so starting in 2026, there are new rules that are going to impact people that are 50 and over, and then there's a sweet spot between 60 and 63. So there's the first is the catch-up. So if you're in that 50 plus, you're going to get an $8,000 increase or the availability. Now
this is in 401k.
This is in a 401k. Now here,
401k, 403b, other type of.
Correct. So keeping in mind, this is on top of what the cap is. So the 24,500 cap for 26. So you can get up to 32,500 in there. Now here's a little bit of a play, depending on what your taxable wages are based on Social Security. So if you're over 150, I believe, let me just double check that because it's important. $150,000. You're going to have to put those funds in a Roth account. Okay. And then the same goes if you're in that 60 to 63, you get 11,250. So up to $35,750 can be the super catch-up. But again, you have to look at where your wages are going to be, and that is going to make which type of account it goes into the vehicle that you have to use based on this new change to the law.
So just to kind of summarize, for that 24,500 that everybody has the ability to contribute up to, that can be made using both pre-tax and Roth based on whatever you choose. But then once you get into the catch-up, that's where it's all got to be Roth.
Correct.
Based on the
correct.
Yeah. And that's, I was just going to share, that's where that part started to really get brought up last year to hopefully allow a lot of retirement plans the ability to add that in, because that's key. So the retirement plan has to have the ability to offer Roth contributions to be able to do catch-up. So if you're in that situation where you're looking to do a catch-up, definitely check with your plan administrator, make sure they have that set up to be able to do Roth contributions, because it's important based upon being able to do catch-up.
Another key thing to remember is the employer match. If that's part of your plan, that's going to go in as if it was pre-tax. So
Mhm.
just a little nugget there to make sure there's a distinction. They don't have the option quite yet to give you those employer matches via Roth.
Now, we were talking about mainly just retirement plans, but there was no changes to IRAs from that standpoint, correct? It was mainly
Just the typical adjustments for emergency.
okay. Okay, great. So just want to just make sure to have the difference there on making sure you're aware of what we're referencing there. So let's go to 529s. I would say this has been a nice change in regards to some of the new rules in regards to the expansive uses of 529s. Because I always would get from questions from people that put money into the 529 is the worry and concern about what if I don't need the money? What can I do with it? You know, different limitations. So explain what the new rules are and what some of the expansions are.
Yeah, so this one is going to be a little drawn out because there were quite a few changes, and even to kind of catch people up on changes from prior years, there's been expanded to use of 529 plans, like you alluded to, that aren't just focused on secondary education. There's some carve outs for paying for technology, internet usage as it relates to the school, your books and supplies, K through 12, certain types of schools have been added to that. So there's some use for that. There's an increase to the K-12 and how much you can pull down for that. So that's something that's new. A lot of states are still allowing for a tax credit. So not looking at a 529 plan, it's probably just leaving a lot of tax savings on the table. I know a lot of our listeners maybe throughout this, the US, but specific to Indiana, where we're based out of, there's a 20% tax credit up to $7,500. So that's $1,500 that you can access. And then some of the expanded items, we got to look at credentialing. So like in our world, if we had tried to get credentialed this year, we may have had the opportunity to use 529 plan funds to take care of a CFP or a CPA. They're looking at apprenticeships. They're looking at trade schools. They're looking at a lot of ways to help bolster and transition our workforce. And it doesn't have to just be a 4-year degree, which I think is wonderful.
Oh, absolutely. Yeah.
Yeah. And then what they've done too is if you don't get into a situation where you've used it up, there's a couple different alternatives. You can do a one-time $10,000 towards student loans. And then there's a $35,000 Roth conversion option. Now there are quite a few rules. It has to be around for 15 years. That's how long the 529 plan has to be around. It can't have contributions in the past 5 years, and it's subject to all the rules for converting, a Roth. So
yeah, that one is one that's come up quite a bit. I feel like that's got a lot of headlines of being able to move, but there's a lot of rules to that.
yeah,
And that's where I think it's always good to have a conversation with your advisor to talk through that, just so we're not making any mistakes really on that front.
yeah, understanding right when to kind of slow down and look at all the facts and circumstances, because that really hedges into why it's important to have an advisor in your back pocket, to have the right questions asked, communicate, ask questions, and then come up with creative solutions.
Yeah, I know for, you and I have we've known each other for a while now, and we've, I would say one of the things that's been really important is that having conversations to strategize and think about not only the effects on the investment side, but also the effects on the tax side. And I think having that coordination is really important, regardless of what the topic, but in particular, the 529s right there.
Right.
So those are, I think, some of the big key things, obviously the things that get talked about the most. I mean, there's a lot of other topics, obviously in the big, beautiful bill that we haven't had a chance to address so far. Now, I think one thing I was going to come back to, and you kind of said it earlier, is that, so we're in the year 2026, but everybody is now getting their 2025 taxes put together. So is there anything that people can be doing now to help them with their 2025 taxes?
Certainly. Opening the mail. There's a lot of folks that still are going to receive, documents through the mail. Staying on top of your email. And again, going and being proactive, go into your financial institutions and double checking to see what's available and then pulling those down. I always try to provide my clients a comparative checklist. This is everything that went into your return in the prior years of 24. These are the items that I know are new, and then maybe mark out if there's any of them that have fallen off and provide essentially a roadmap. I feel like that is a really good starting point. And then if you can, as a taxpayer, review that list and think through, wait a minute, did I start a new, interest-bearing checking account? Did I invest in a new alternative investment where I'm going to be looking for a K1? And then just communicate. So if you've got a tax professional, keep them in the loop on, where things are and allow, that communication to be a benefit to you and your relationship to your tax professional. Now, as far as there's anything left that they can do for 2025, there are some items that you can still go back. So, for example, in Indiana 529, if you have it maxed out, you can actually go on the 529 website, do a contribution and mark it for the prior year. So that's still an option. Going back through, if you're close to that itemizing mark, maybe go back and look at some of your charitable deductions, maybe some non-cash contributions where you drop things off at, say, Goodwill or Salvation Army, and take a quick peek, look at for your car tax, the ad valorem tax, try to get a lot of that stuff organized to where, you can use that in a timely, accurate fashion for your tax.
So with the clients you work with on the tax side of things, these are conversations you're having with people right now to kind of think through that. Is that correct? And kind of going over that piece?
Right. Yeah. Just walking them through that. And then, for small business owners, it's all about making sure that your records accurately reflect what took place. This is the time that we're looking at, any asset purchases that took place in that fourth quarter. We've already had a lot of planning, but now it's to look at how to, leverage Section 179. How do we elect and operate around bonus depreciation? The federal, so part of the new bill, and we can touch a little bit on businesses, is they brought back 100% bonus depreciation. And it's funny, the date that they picked was, I believe it's January 26th. And for the life of me, I kept cracking jokes. I thought it was going to be, they picked it out because a congressional rivals, like business rivals partner or something, put fixed assets in service the day before, but it was when they put it into Congress is when they announced the bill.
Okay.
So they missed an opportunity, in my opinion. But one of the good things is bonus is back. But with our small business owners, it's navigating how do we structure bonus in Section 179 or a cost segregation study for a major acquisition of a business property. And then we can kind of manage and go through those and look how we manage the state adjustments that are related to when states don't comply with the federal tax rules. So looking at it globally. And then right now is also a good time with the new bill is to look at your entity structure. Because there's a lot of changes with the rules related to the 1202, Section 1202, which is the qualified small business stock. So that's a unique vehicle to put a business in if you're looking to sell it. And there's a ton of rules to get this done. So we have to be very structured and organized to get this across the table. But it can be a huge benefit, especially for a young company that has assets in a certain level, because you can accelerate and it used to be, it had to be on the books for 5 years for it to qualify to write off, to be exempt from a gain upon selling, right? Now it's an accelerated 3, 4, and 5 year. 5 years, so 100%. So it's just an opportunity to try to look at someone's situation and say, and this is my favorite thing is like, what are your plans? It's not a tax compliance question. Is what are your plans now? What are your plans next year, the following year? And try to figure out a good roadmap for our clients. If any of our clients have research and development credits, that's a new one. So the IRS was having people capitalize those, and the new rules are able to fix that issue. So they have a couple different options based on your gross income of the business, and they can either write them all off now, they can spread it out over 2 years, or they can file amended returns based on their situation. Now there's a threshold. If you're a higher gross revenue taxpayer, you're not allowed the same rules.
Okay.
So you can't go backwards. You can just do it this year and the following year.
Okay.
So, but they put in some unique flexibility, in my opinion, to fix an issue. They've addressed it and given some flexibility to figure out a creative way. Again, like our income stacking and bunching for deductions, it's no different for a small business owner than it is for a 1040.
Yeah.
Only. Yeah.
Well, it's good that there's some positive things to share on that front.
Absolutely.
Well, for the time's sake, let's move on to some questions. So,
okay.
We've had some questions that have come in. Feel free to continue to type away your questions. Like I said, we'll try to address as many of them as we possibly can. So I'm going to look through here a couple of them. I think we just answered one, but I'll kind of go here to the next one. So Owen, is there a resource that you would recommend for taxpayers to find out more information about legislative updates at the state level? Because I know we've talked about the federal. That's a good question. So
yeah. So I think it's important to understand the source.
Okay.
If you go into Indiana, for example, Indiana has the end time. They have publications, they have resources. I always suggest going to the source and being careful what you hear on TikTok or Twitter or Facebook or whatever, Instagram, like whatever social media you're scrolling through. There's a lot of people that, get on, they don't have credentials. And some that do still aren't maybe given the best advice because a lot of this is situational based. So, if I'm walking through a complex tax situation with a client, I need to slow down. Mm-hmm. I need to help navigate and understand where they are, what are the facts, and understand the global picture. So federal and then also state level is, the best thing to do is have a good advisor. Mm-hmm. The second part, if you're not quite there yet, is to go directly to the state website and try to get as much information from the state publications as possible.
Okay, that's good. There's another question that came in that I think actually just feeds off that really well. AI obviously is something.
Oh boy.
AI is artificial intelligence. So I think this is a really good one. What is your experience with using AI for tax-related questions? Is it a reliable resource?
So there's a lot to this. We could probably have a seminar on this and we wouldn't even graze all of it in a week. I was asked this at a few weeks ago when it was an industry podcast and we're talking about how this is influencing our profession. And my big takeaway from it is I planted my flag and said, you have to be the author. You can't allow AI to be the author. So, and what I mean by that is if I'm leveraging AI, 9 times out of 10, I want to know exactly what I'm putting in, and I just needed to kind of fine tune or tweak. Mm-hmm. Now, we are very limited on the AI tools that we can leverage because of our industry standards, but we can still use those and then go above and beyond and say, we can build parameters around if there is a question. But I have to, in my due diligence, go find the proof in the pudding and make sure what I'm, having, okay, on these different types of areas, what does it look like? Mm-hmm. I could have AI tell me, oh, it's this. Well, Darin, what did we just talk about? All these changes. If I'm not specific and say this took place in 2025, AI may hallucinate and give me a wrong answer, or AI could hallucinate, or not hallucinate, but tell me the rules from 2024. Mm-hmm. Now, technically, AI is not wrong. It just got bad information. So I think AI can be a tool. If you have your, a co-pilot that's linked to your Microsoft, is it great to, before you send out a memo or an email to have it look at your grammar? I remember hitting F7 for spell check, and I would never, submit a paper in school without hitting F7 to spell check it. Mm-hmm. And even spell check, though, it wasn't perfect, right? Because there are certain words that, although technically they're not spelled wrong, they're not in place.
They're out of context.
They're out of context. Yeah. And again, AI is not a human. Mm-hmm. And what we've found in what we brought to the market is people want relationships. They don't want a robotic response. They want good, timely information, good advice. Mm-hmm. And AI can be a tool, but it can't be the tool.
Mhm.
So
Yeah.
I hope that was,
No, I think
I
that's
tried
great.
to trim it down a little bit.
Yeah, I mean, it's hard to avoid AI, and, any business right now. So it's a very good question. Go to the next one here. Oh, here's a good one. When should I expect my 2025 tax documents to be available? I can address this and maybe you can get
Oh,
the
sure.
feedback too.
Absolutely.
So, we on the wealth management side, we custody all of our client accounts at Charles Schwab. And, for a lot of accounts, you will start getting your 1099 tax documents in February. We were told they could come out in 3 batches. So there's one batch that comes out beginning of February, another in mid-February, or excuse me, beginning of February, mid-February, and the end. So what we're expecting is for most of our clients to get all their 1099 tax documents by the end of February. Now, there still could be some corrections that come out. I know that's always been a big thing is, okay, well, they may come out with the first batch. Hopefully, there's not much in the way of corrected 1099s, but still something you want to keep an eye on. Are you seeing anything different with other institutions or anything like that, or is February usually?
Yeah, I think that's fair. The big thing are W-2s and 1099s. We've already seen an influx. Those should have been delivered by January 31st. Looking at anything beyond that, you're looking at mortgage statements. Those have gotten pretty streamlined. And then, yes, the brokerage statements, the interest statements, those come pretty quick. But it is maybe the more complex when there's dividends, capital gain, distributions, maybe some cap gain transactions. I do feel, as technology has gotten better, we've seen a better clip rate at getting those in. And then another part is, if you have K1s that are coming from alt investments or other businesses, and this is where it's important to, again, communicate with your tax advisor, your financial planner, and make sure you have a game plan in place. I was speaking with a client, excuse me, and they were in a new alt investment, and the investment provider said essentially, don't expect your K1 until August. And that's a long way. But I've been walking alongside this person all year. I know exactly what, the rest of his information looks like. We have a good guess on what his K1 is going to be. So we're going to build into an extension payment, his first quarter safe harbor, and that's going to be the full extension payment. And then whatever little bit of fluctuation, we've got it covered, and then we'll carry over that overpayment. We won't file until August. So, but the whole premise to that is if your stuff doesn't come in time, don't panic, communicate and come up with a plan, a proactive plan to address it, and then don't let it be an emergency.
Yeah, great advice. Yeah. Got another question here. I like this one. This is kind of straight to the point. Bottom line, is the Big Beautiful Bill beneficial to those with relative wealth? We know that the primary beneficiaries are those in low income brackets.
That is a great question. On a relative scale, the tax system has not always benefited the lower versus the higher. Yes, income tax brackets are higher. A lot of the lower income earners, and this is a good segue back to our first topic, is the no tax on Social Security, no tax on tips and overtime. Overtime and tips, they were still subject to self-employment tax. Well, not the employer side of FICA and Medicare. So 7.65% of their income is gone. So if you have portfolio income, it's not subject to that. So there's a little bit of back and forth to understand that, some of these higher income earners, they're able to get some income, and it could be capped at 20% for long-term capital gains or long-term capital gain distributions. That could be higher than someone's, 12% income tax rate if they're subject to those other taxes. So I think there's a ton of benefit for both.
Okay.
So I think some of the higher income earners, you're capped at the 37.6. There was another almost 2% coming your way. If you're a high income earner and you have a small business, that 20% QBI deduction, that was going away. So, and then they didn't impact the C Corp tax rate. So if you, have a very well high income earning C Corp, your tax rates are pretty historically low right now. So I think it's fair to look at both sides because the Social Security, or sorry, the no tax on tips, and there was just a lot driven at that, and then the no overtime. But there's still tax that is being thrown at them that's different than what other high net worth people are able to capitalize on.
Yeah, I think it's a great explanation. Let's go to the next one here. Any new tax changes which are important for new retirees?
So that's a good one. And I'll put it more of a holistic perspective because there's certain life changes that having a good financial advisor and a good CPA are paramount. Moving from your working years into your retirement years, that's a great opportunity. And hopefully you had someone walk alongside you beforehand. Some of the strategies, and this is something to make sure that you're not getting caught off guard, because that's the worst feeling is you go through a life change, maybe you get married or you go through retirement, and all of a sudden you're not used to having that type of income. And then all of a sudden your withholdings aren't right. And you're in a different tax bracket. And then this isn't talking to this, and you don't have a plan together. And then all of a sudden you've got a pretty big tax bill. And there's no tax strategies around that because that's math. That's not planning around having the right withholdings, the right, quarterly estimates. For retirees as they get older, obviously, we've got, the charitable distributions that we can walk people on, but that's not until a certain age.
Elaborate on that because that
Sure.
comes up quite a bit for those. I mean, this may not be for retirees, but mention I think where you were going with that is qualified charitable distributions from retirement accounts.
Correct. Yeah.
Explain that because I know that comes up.
Yeah, well, and this is important now because if we look at the reduction in the benefit on your Schedule A itemized deductions for charitable deductions and the fact that there's still a pretty high threshold for itemized deductions, you can still be charitable through your distributions, the required minimum distributions, and you can aim those directly at the charity of your choosing. And the good thing about that is it can get around the limit on itemized deductions. It could get you around some of the limits we talked about with your AGI limits or modified AGI limits for the Social Security deduction. So that's a unique strategy to make sure you're thinking about the different ways in which you're charitable, the ways in which you're pulling down those funds.
Yeah, I just want to make sure to elaborate that. I mean, the only other thing that comes up may not be for new retirees. I get a lot of questions about healthcare premiums and how those are affected by income. So that's obviously something there, Roth conversions, but.
Right. And that all goes to looking at your current year and then being slow to pull the trigger on certain activities that may trigger taxable income because you want to be certain that you're not putting yourself in that next bracket where you could increase your Medicare premiums, right? And then also like tax loss harvesting. That's another way to make sure that you're keeping your tax bracket in the forefront, so to speak.
So no significant changes, I would guess, for new retirees for what I would hear you say, but there's still a lot of tax planning things that need to be done.
Correct. Yeah, the tax. The income coming in is still subject to federal and state taxes. Some states don't tax on retirement income, so that's something to keep into account. You're also not going to be subject if it's coming through a 1099-R. There's no Social Security, no Medicare coming out anymore. So that's something to keep in mind. There's going to be more left for you, because you're not subject to that 7.65% combined between the two of those. Yeah, but all the tax saving strategies for individuals are still on the table. It's just you have to have the conversations to figure out what are your goals. What's your income level? What tax bracket are you in? What investments are you in? Are you charitably inclined? Do you have a mortgage? What income level are you? There's a lot of different mitigating factors, and we can talk about being very intentional about do we take a big distribution now and split money in a donor advised fund and kind of match the higher income to get a bigger return on a donor advised fund, and those you can distribute to the charity little by little or as much as you want. So,
Yep. Well, last question. Going back to Trump accounts.
okay.
So does the Trump account convert to a regular IRA for a child who turns 18? If so, can the child convert the account to a Roth account at that time?
That's a great question. Again, all the wrinkles are being worked out when we talked about this earlier. The idea behind it is they essentially get turned into a functioning IRA. I don't know the answer to that. So it would appear that could be where we're headed, but there's no indication that I've seen that has been put in black and white. There's exemptions to where you can pull it out for childbirth and adoption expenses, for first-time home buyers up to 10 grand, and then for qualified education expenses. But all that does is it saves you from a 10% early withdrawal penalty before they're 59 and a half, which is the retirement age. So, and if it gets pulled out beforehand, then it's subject to, the principal is not subject to income tax, but the earnings are. So we may have to circle back to whoever asked that question. It's a fantastic question.
Yeah, I mean, as we talked earlier, it seems like that's one of the big things that's out there that gets talked about that's still trying to be wrinkled out on that front.
Yeah, there's quite a few in this new bill, and luckily some of them aren't being taken into account until 26. So it is going to give, the IRS and all the state filing agencies time to get their heads wrapped around how the forms are supposed to look, because some of this is just new.
Right.
So
I think it's great. I think we're able to get through quite a few questions. If we weren't able to answer any question that you had, I mean, feel free to reach out to us. Even if for your own specific situation, if there's a question that you had that you didn't really want to mention here today, feel free to reach out to us. We're happy to talk with you individually. The other thing too is we're going to try to make this webinar recording available by the end of this week. So if you have an interest in getting that, please let us know. But Owen, thank you very much. Thank you for joining us. It's great to have a conversation with you on this. We'll try to do a webinar about once a quarter. So keep tuned in, and hopefully we'll see you on the next one. Thank you for joining.
thanks, everybody.